And we're going to start off with, the umbrella effect. So in the loan industry, there's what's considered A paper loans. Now, it used to be there was A and B or subprime. There still is kind of those designations or segments, but for the most part, all loans are A paper loans nowadays, unless or until you get into the non-QM. So, of course, you've all heard of FHA, VA, USDA, and conventional loans. They're still out there. They still have their similar guidelines, but then there's the non-QM or non-qualified mortgage. And that's a little bit different, but it's nice to have because, when the Dodd-Frank Act came out and they invented the CFPB, Consumer Financial Protection Bureau, that put some additional laws and guidelines into our environment that restricts a few things for borrowers. So it's nice to have that non-QM bucket in order to do a lot of self-employed borrowers, perhaps a bank statement loan, and these types of things. So let's take a look. So, of course, the industry has always had loan limits. And so what's a loan limit? Well, you have a conforming loan amount, and then you have a high balance now, and then you have a jumbo. So you'll see on this grid where it's FHA, this 442,750 is the conforming limit. So anything 442,750 or less is conforming, whether it's any type of FHA rather. And it used to be that they were the same, FHA and conventional, but they changed up, and that's fine. So conventional conforming 510, 400. Now it does depend on the area. So these loan limits are divided out per county. So you see where the FHA in San Bernardino County is the same 442,750. 442,750 is the lowest. That's the bargain basement, right? That's the lowest limit on loan limits by county. But then you see down, say, LA County for FHA, 765,600. So that means that if your loan amount, not the purchase price, but your loan amount is over 442,750, but under 765,600, then you're in high balance. So up to 442, conforming. Over 442, up to the county loan limit, high balance. Over the county loan limit, jumbo. Okay, so FHA doesn't do jumbo. They simply do up to the county loan limit. Now, county loan limits can be higher if you have units. I haven't put that on this chart because we try and keep it simple. And this topic generally gets a little more complicated than it needs to anyway. But if you have units, then the loan limit for that county is even higher. So then you look at conventional and it works the same way, it's just different numbers. So 510, 400 is the conforming conventional loan limit for all counties, but the county loan limit for LA, 765, 600, same as FHA, as is San Diego, same as FHA. But you can see that San Bernardino and Riverside counties are the 510, 400, higher than the FHA loan limit. These are taken into consideration for you when you come in to either get pre-approved for financing to buy a home, or you're refinancing your current home, that we have to plug in that limitation, in which case helps us to price the loan. So the investor is going to be at higher risk if it's a high balance loan or over the conforming loan limit. So your interest rate will be a little higher. So that's part of where this comes in. Also, your loan to value often will be a little lower. Not in all cases, but often it will be. Now, VA is an interesting one. And VA's limits are the county loan limits, and jumbo over the county loan limit. So jumbo is real interesting in reference to VA. So FHA has no jumbo. Conventional simply turns into jumbo over the county loan limit, and VA jumbo works awesome because that amount over the county loan limit that's into the jumbo loan limit, the veteran only invests 25% of the difference. So let's just make easy numbers. $1 million purchase, loan limit, let's say of 700,000. That leaves 300,000 that's into the jumbo area, 25% of 300,000, rough math, 40 grand. So 24, 75 grand. So $75,000 is what they would invest because it's 25% of the difference. So they're putting down $75,000 on $1 million purchase. Now that's a nice loan. USDA is even more interesting that they don't have loan limits. And their pricing is based a little bit on the loan amount, but they're income driven. So in reference to their loan limits, as long as your income fits into their lookup trigger, then it's okay, whatever loan limit it is you're buying. However, for instance, often their income limit, for instance, for San Bernardino and Riverside County is about 60,000. So you wouldn't be able to buy a $500,000 house with $60,000 in income. So very interesting. Okay, enough on that. Let's take a look at the different types of loans and different loan to values and such that are illustrated with like an FHA. So an FHA is a bit of a larger box. So they will take a lower FICO score. They will allow a higher CLTV, combined loan to value, often. But their guidelines also are a little bit more general and a little bit more wide open. So usually, um, we put the whole scenario together as to which program you would want to work within or what's available to you. And generally, we're going to look at conventional first. And if you're outside of the box of conventional, you're probably going to fit into FHA. Of course, if you're a veteran, we always want to look at VA before anything because VA loans have the least amount down, the least fees. VA loans are fantastic. And if any of you have heard of the blue water rule that came into effect, which includes uh, Vietnam, Korea, Gulf War veterans, and anyone associated with that, a few other items fall into it, and I just don't want to get too deep into it. But that changed the funding figure that the veteran would pay at closing and makes many of those veterans exempt. So very interesting. So if you're a veteran, please give me a call. Let's chat about this. The guidelines are really, really in your favor. We talked a little bit about USDA in reference to loan limits and income limits, but another interesting thing with USDA is a lot of people would think, okay, so this is a rural area loan, so I can buy a ranch, I can buy a horse farm. Nah, it's still for owner-occupied single-family residences. It cannot have a swimming pool unless it's a brand new build. And generally speaking, it's a population area of 25,000 or less. So um, it's an interesting loan. It's 100%. It has low mortgage insurance, which we'll talk a little bit more about. But that's a not a loan that you see very often. You would see it in perhaps Romaland out in Cuyamaca, past El Cajon, San Diego area. The smaller communities, you'll see these. And then little pieces of them in and around, say, Lake Elsinore, south of Marina Valley, that area. So definitely an option and always something to keep on the table. So let's chat a little bit about if you're outside of these boxes. So non-QM or non-qualified mortgage. And we have that there on the screen because, it does kind of need a little defining. So the ability to repay must be proven on a QM loan. The loans above are all QM loans. They're qualified mortgages. And in order for the government to pay for them, or rather to buy them in these pools, it has to be a QM loan. So a non-QM loan has different income requirements for proving that they can pay that doesn't fit the QM rule. So the ability to pay is still proven, but it's proven differently. For instance, a business owner can give 2 years bank statements. The deposits are averaged, and depending on how many employees they have, they're using a percentage of that as their income. So if it's a sole proprietor business and like a loan I did recently, He was a concrete contractor and didn't specifically have employees. He had day workers occasionally, but all of his income was allotted to him. So all of his deposits into his business bank account were average, and that's what he was given as income. So that's not acceptable income for a QM loan, but it's certainly acceptable income for a non-QM loan. Restrictions on risky loans. So that is, there is a CFPB rule and a Fannie Mae rule that do not allow loans to be more than 2% over the APOR, the average prime offer rate. So all the loans that are done during or in the nation during a week are tabulated, and the APOR is brought up, which is the interest rate, the average interest rate for all the loans that were done. And you can't do a loan that's more than 2 points over that APOR. It's posted every week. And if you're trying to do one, bam, it fails. And it would not pass the QM rule. So you would not be able to close that FHA via USDA or conventional loan. However, non-QM doesn't have that rule. So the interest rates can be higher. Not that you want them higher, but you do want a loan. And given that the national average interest rate for our nation, since we've been keeping track, is 7%, getting a loan at 5.5, whereas the APOR right now is about 3 1/8, 3 1/4. So 2 over 3 1/8 is 5 1/8. So if you got a loan at 5.5, but you're doing it off of bank statements, you'd probably be happy. So that's why non-QM loans are available. There are limits on points and fees on a QM loan, but not on a non-QM loan. So the points and fee restrictions do vary depending on the loan amount, because it does go all the way down to $0 or 9,999 actually of what the fees can be. But for our purposes, we're generally not doing loan amounts less than 100,000, so 3% is the rule. So um, non-QM is a box that we love to have around because there's plenty of borrowers out there that need it. Okay. And remember, feel free to just jump right in if you have questions, because I probably have an answer. And if I don't, I know a lot of smart people in the industry and I can get you an answer. Okay, so let's take a look at the items that are required for loans. So generally speaking, on an FHA via USDA and a conventional loan, pretty much all the items that are required are the same. Now, when it comes to student loans, which is that's a great point that I bring up just off the top of my head. There's a lot of people that have student loans that maybe owe $100, $200,000 that don't feel they can afford or that they can qualify for a mortgage. Um, and you may, and you may not, but we have to take a look. I qualified somebody a couple weeks ago. They didn't actually believe me that they qualified. They went to somebody else and they, yeah, you do qualify. And that's fine and dandy. As long as you get what you're looking for, I'm happy. But just because you have a student loan doesn't mean you're not going to qualify for a mortgage. So let's chat. Let's run the numbers. The numbers always tell us the truth, and let's build a plan. It's always better to have a plan for success than just not knowing. So moving forward, different loans have different guidelines, but for the most part, the documentation that you're going to provide is the same. So for a W-2 wage earner, salary type employee, they're simply going to provide the last 30 days of pay stubs and W-2s. They may, in fact, have to supply tax returns, but generally not. And that just all depends on what the automated underwriting system comes back with. But generally speaking, if you've been a W-2 wage earner for 2 or more years, then all we're going to need is W-2s and pay stubs, current pay stubs. In reference to those pay stubs, it really does need to be full time. So 36 hours a week isn't considered full time. It's mostly considered part time or variable. The underwriters call it variable income, which would be averaged. But those types of rules and guidelines are the same for the most part on all of the A paper loans. Some of the places where they differ is FHA, for instance. You wouldn't be able to do a second FHA loan So you have an FHA loan and you want to buy another property, or you have a conventional loan, you want to buy another property, but you're buying it FHA, you wouldn't be able to buy it unless it is over 100 miles from that property that you have. Now, if you're going to sell it and get rid of it, then sure, you can do that. But there's lots of little quirky rules like that. And the 100-mile rule is simply one of them. And of course, you got the 3 1/8 down there, 3.125. Yeah, fantastic rates. I think that's probably the biggest reason I put that down there is that rates are so good that if you haven't refinanced within the last year, we probably should chat. Okay, let's take a look. So we talked about the loans and the different types and different guidelines in reference to loans, but mortgage insurance. So let's talk about this. Mortgage insurance is required on a conventional loan with greater than 80% loan to value. Generally, on a purchase, you're going to be about 95% unless you're going to put some money down. So they're going to require mortgage insurance. This is an example of a rate card for mortgage insurance. And you'll see that if my cursor is showing up, you'll see that the loan to value is on the left-hand side. The credit score, which is the lowest mid FICO score in the file. So if there's two borrowers and one has a 700, the other has a 680, the lowest mid FICO, because there's three scores, one has a 7, one has 680. Lowest mid FICO in the file is the determining FICO score. So we would go with 680, right? So if you have a 95% loan, 680, you're going to be at 30% coverage, 0.96. So 0.96 is your factor times your loan amount divided by 12. And that's how much your monthly premium would be for borrower paid monthly mortgage insurance. Obviously, it goes down. If you're at 85% with a 680 FICO, it's 0.28. There are additional adjustments. So if this was a 3-unit, 2, 3-unit, 4-unit, more than just a 1-unit SFR, then the rate would be a little higher. If this was non-owner, rate would be a little higher, those types of things. But you can see how this is your monthly mortgage insurance that's tacked on to your payment. So you have principal, interest, taxes, and insurance, and mortgage insurance, and perhaps homeowners association. So there's lots of things that go into a payment. This is mortgage insurance in reference to a conventional loan if paid monthly. Now, one of the things that's always in the tool bag that you rarely ever, if ever, hear about is using mortgage insurance to buy a house. What do I mean? So let's say that you're not quite qualifying for this $400,000 house that you really, really want because the payment's a little high and you're restricted to a 45% debt to income ratio. You're at 46. You need it a little lower. The seller's not willing to reduce the price. And even if he did reduce the price, he couldn't reduce the price responsibly enough to get you down, your payment down a full percentage to get to 45 or less. But what you can do is have the seller or yourself, the seller pay lender paid mortgage insurance or perhaps a split premium, which would reduce your mortgage insurance and your payment and your debt to income ratio. So knowing the ins and outs of mortgage insurance is extremely important. That's just one example of how we help our clients. And let's talk about FHA and mortgage insurance. So of course, PMI was our conventional mortgage insurance. MIP, mortgage insurance premium, is for FHA or government insurance, mortgage insurance. Now, this is a bit different. Mortgage insurance for an FHA is upfront mortgage insurance, UFMIP, you see on the right there, upfront mortgage insurance and annual mortgage insurance. Another way that conventional and FHA mortgage insurance differs is that conventional mortgage insurance drops off when your loan gets to 78% during normal payment reduction and amortization. You can, after 3 to 5 years, depending on the policy, um, request that it be dropped if your property has appreciated and can be appraised at less than 80%. Because remember, conventional loans are only mortgage insurance required at above 80%. So if your home is 80% or less loan to value, you can drop that mortgage insurance. As opposed to FHA, if your loan to value is 90% or higher, the mortgage insurance on an FHA that's paid monthly is for the life of the loan. Um, Very important to note. So if you have the loan for 30 years, you're paying mortgage insurance until the day that loan's paid off. If you refinance the loan within the first 3 years, your upfront mortgage insurance, the 1.75% of the loan amount, which can be financed, so you'll be paying interest on that as well. But the 1.75 will be partially refunded to you if you refinance within the first 3 years to an FHA loan. If you're refinancing from an FHA loan to a conventional loan, there will be no refund of the upfront mortgage insurance premium, but generally speaking, you will definitely get rid of your FHA. In all cases, you'll get rid of your FHA MIP and perhaps your conventional MIP or PMI would be less because the loan to value is lower because of appreciation. So hope that's not complicated or too tough, but going to the chart on the bottom, you have less than 625,500 if your loan to value is less than or equal to 95%. You're going to pay 80 basis points of mortgage insurance calculated on your loan amount divided by 12. That's a monthly payment. That's for greater than 15-year terms. This is less than 15-year terms. So I think the biggest thing to take away from this is that FHA mortgage insurance is for the life of the loan if you're at 90% or higher LTV, and that there is upfront mortgage insurance as well as monthly. So oddly enough, the FHA interest rates are generally lower than conventional, but it's the blended rate that you should be interested in because that's what you're paying on. So if you calculate in the mortgage insurance on a conventional and an FHA, um, generally speaking, conventional is better off. Okay, so let's chat a little bit about non-QM. Firstly, let's chat since we were just going through mortgage insurance. So generally, a non-QM loan is not going to have mortgage insurance. Now, I say that with a little bit of a slanted cheek and head because, honestly, all loans at 80% or higher have mortgage insurance. It's whether or not you're paying it, they are all insured. So really, a non-QM loan has mortgage insurance. You just don't see what the rate is. It's built in. It's not something you can get rid of. Generally, you're going to keep a non-QM loan only as long as you have to anyway. Once you change, your scenario and you can get a regular conventional loan, you're probably going to do that. But there's borrowers, many borrowers that don't have a choice but to keep a non-QM loan, and that's fine and dandy. Yeah, sure, it's a little bit higher in interest rate, but it still gives you the ability to buy that house or refinance that house. So yeah, it would still have mortgage insurance. You just don't see it. But non-QM loans, I had illustrated before that you can certainly get with bank statements. It would be business bank statements and personal bank statements. So it just depends on which is going to work out best for you. Um, you would need to be the business owner or at least 25% of the business owner and calculated accordingly. There is also asset depletion or reduction loans. So if you have an inheritance, if you have a huge bunch of money because you were a serious breadwinner in the past and just saved a ton of money, and you're using that, you can do asset depletion as long as that asset is able to continue to pay you for 3 or more years. That can be used as income. So if you have $1 million and you're taking, I don't know, $10,000 out a month, and that obviously would last more than 3 years, then $10,000 in income is what your debt to income ratio would be calculated on. Really interesting. Stated loans are interesting, and stated Nina and NEVA loans were really used before 2008, wildly overused, wildly oversold. But stated is where you simply say, I make this much money and you believe me. Obviously, that's not a QM loan because you're not proving the ability to pay. But generally speaking, a gardener isn't making 15 grand a month. Lots of loans like that were going through prior to 2008. And these were guidelines that allowed it up to 95, even 100% on stated loans. But that's not the case anymore. They're certainly allowed, but the loan to value is going to be much less. And the interest rate is certainly going to be higher. But hey, that's another tool that we can use. No income verified assets says what it is by itself, and no income, no assets. So what are you talking about? No income, no assets to qualify for a loan? Yeah, think about buying a commercial building. You wouldn't buy it with a Nina, but I'm just saying, think about a commercial building and how commercial loans go. Commercial loans are all about return on investment. What's the cash flow of that business, kind of a thing. So a no income, no asset loan, if you're willing to put 40% down, then surely the investor is willing to put 60% down. And if you miss your payments, it's his house. So he just gained 40% of the property's value. So obviously, these types of less documentation loans are more dangerous, more risky for the investor, and tougher to get, and lower loan to value, higher interest rates. Equity loans as well, and that kind of speaks for itself. So lots of different loans out there. Interest rates on those lower documentation loans would certainly be higher, but well worth chatting about. And reverse mortgage. So a reverse mortgage is heavily regulated nowadays. And in the past, I mean, even say 5 years ago, it wasn't nearly as regulated, but it is certainly regulated now. And I love a reverse mortgage. For some reason, they got a really bad name. I'm pretty sure because of false information that was circulating. So let's get to the real facts here. So yes, you have to be 62 years of older. Yes, you need to have equity in your property. Even if it's a purchase, you would have to have equity because you would put a large down payment down. But a reverse mortgage, I like to refer to as a retirement mortgage because you can do the mortgage whether you're getting a lump sum cash amount of the property. Let's say it's worth $100,000. You go up to $70,000. You take the whole 70% out, and you don't make a payment till at ever. You don't make a payment, and it's a loan. It's a government loan. They're not going to foreclose. It's simply a loan. Whether it's exactly like an FHA loan, it's simply a lien on the property. But a reverse mortgage, a retirement mortgage, um, simply sits there, and when that borrower passes away, just like a loan, the heirs have the opportunity to pay it off, refinance it, sell it, whatever, and simply pay the loan back. Yes, interest accumulates on the loan just as it does on a conventional FHA, VA. Doesn't interest always accumulates? But the point is they're not making a payment. They're not selling their home to the government. They own the home. The heirs still inherit the home. It's wonderful. Or perhaps they would like to do the exact same loan, but they'd like to have monthly payments. So they receive monthly payments on the loan that increases the balance owed. They don't repay it. They simply, when they pass, they the property is inherited. They sell it. You do whatever you want with it, kind of a thing. So again, you're not selling your home to the government. It's just a regular loan. It's a retirement loan. You're not making payments. It's a beautiful thing. Oh, well, wait a minute. Uh, you know, Bob married a younger lady. Bob's 62. He's getting the loan, but his wife is 50. Bob passes away. What happens to the property? Well, as long as the 50-year-old new spouse has signed on the paperwork as living in the property and it's done correctly, then as soon as when Bob passes, it's his spouse's, his widow's property, and she can continue to live there until she passes, again with no payments. It's an awesome loan. Feel free to chat with me or research it or chat with whomever it is that you feel is knowledgeable enough to help you with this. There are counselors that the borrower has to chat with. And yeah, I, I really like them. Okay, enough on that. Ah, down payment assistance. Where do we start with these? So in the example down below, you see it says Cal HFA, Open Door, GSFA, Platinum. And yes, there are certainly over 140 different down payment assistance loans available in California. FHA, VA, and conventional, there really is not any non-QM because that would require at least 100% or higher, perhaps up to 105% loan to value. So FHA, VA, and conventional, remember that VA is 100% loan, but if the seller's not willing to pay closing costs and the veteran doesn't have any money, then perhaps you would need to put a community second on there in order to pay some closing costs. So let's just look at Cal HFA real quick. So Cal HFA, California Housing Finance Agency, is all their money is brought in by itself. It's not bond money. It's not government money. It's self-perpetuating. So the monies that they make from the loans help to do the rest of the loans. They used to subordinate or stay on title and not make you pay their seconds when you refinance the first, but they got to a point where we need to recoup some of this money. They're starting to get a little low, so they did away with the subordinations. So on a Cal HFA, FHA, you could do a 96.5% first, a 2% second, and depending on how you're positioning this is, oh, there we go. Okay, so a 2% or even a 3% zip. So if you did the 3% on top, then you would be at 99 and a half, right? 96 and a half plus 3, 99 and a half, and then a 3.5% my home. So that makes it 103% combined loan to value. There's 3 loans, but really you're not making any payments on the second or the third. The ZIP is a zero interest program that you can get that's either 2 or 3%, and that is going to be repaid. But again, there's no interest on it. And the My Home at 3.5% is last I looked was about a 2% interest rate, and that can change daily, but that's simple interest, so it's not compounded. So if you had easy numbers, a $10,000 My Home, which is the second, because the ZIP would have to be the third, but you have a $10,000 second at 2% simple interest. That's $2,000 every year. That would be added to it. That'd be 20%, 2%, $200, excuse me, every year. So it's not, you're not then paying 2% on the 10,200 on year 2. You're just paying the $200. Bam, bam, bam. And again, you're not paying, it's simply accumulating so that when you refinance the property, sell, or the first terms out in 30 years, that's when it would have to be repaid. So that is probably one of my favorite down payment assistance loans. It is a reduced DTI of 43% with a minimum 660 FICO. It does allow for manufactured homes, but the manufactured home FICO score is 680, so it's a little bit higher. But there are income limits on their FHA and conventional at 138,000. So that is something to consider. And you know what? I am tired of looking at that same screen. So how about you just look at and me. Okay, this might be a little easier for you. So anyway, back to Cal HFA. So that was the FHA. Let's look at the conventional side. The conventional side, of course, for a first-time home buyer can be a 97% first, And then you're still going to have the options of having a 2 or a 3% zip with a 3% My Home. So that's still going up to 103% combined loan to value. Same FICO scores of 660 and 138,000 in income limits. But this one works out really well. The interest rates are pretty darn good. It doesn't get you as much money as, say, Open Door. I am doing an Open Door right now, and you know, we look at the whole scenario in order to figure out what program is best. In this case, our clients need the Open Door because they simply don't have enough money to close, and the Open Door gives them the most money. Open Door, because it gives them the most money, is the highest interest rate. So on that, in this particular case, and could be different for everybody, but the rates are pretty standard and don't change. Rather, the rates may change, but as long as you have the minimum requirements, the FICO score, the DTI, these kinds of things, then the interest rate is about the same, as opposed to if you're doing a regular loan, the interest rate can vary depending on FICO score and loan to value and these kinds of things. So anyway, back to the Open Door. You can do Open Door, FHA or conventional, and so that would be a 97% first on a conventional, 96.5% first on an FHA. It does go up to 105% CLTV. In our case, the max that we could get is a 5% second that, again, there's no payments, but the interest rate was about 4 5/8, 4.625. So definitely higher, about a point higher than CalHFA, but it gets us an extra point. So it gets us up a little bit higher than we would have been able to go with a CalHFA. Also, another interesting thing is in reference to these borrowers is Open Door, back up. FHA said about a year and a half ago, they said, it's not fair to have income limits just because you make more money that you can't be assisted in buying a home. So FHA outlawed having income limits on down payment assistance programs. However, CalHFA still feels that it needs to have income limits, so it does. But Open Door doesn't have income limits on FHA. Conventional does, but FHA doesn't have income limits, and that's why we had to go with this program, Open Door, for our clients, because they simply made too much money to go CalHFA. Okay. Also, Open Door goes to a 55% loan to value and can go up as high as a 7% second. So you can see that the 7 and the 97% first and the 7% second, that would get you a lot of buying power, and you're not going to have to write a check. If you do, it's very small. So that's an awesome loan. I don't look at it first because of the higher interest rate, but again, every scenario has its requirements. Another very interesting one is Golden State Finance Agency, GSFA, Platinum. Now, I like Platinum because the second disappears. So you can do, for instance, a conventional or FHA. Conventional is 640 minimum FICO and FHA 660, both with a 45 max DTI, debt to income ratio. But if you have a 680, you can go to 50% DTI, very nice. And you can get a 5% second that has up to 5%. And the interest rate in reference to GSFA is the higher you take the second dictates what your interest rate is on the first. So if you take a 5%, let's say the interest rate is going to be 4%. But if you take a 4%, interest rate might be 3.75. Take a 3%, interest rate might be 3.5. Okay. So what you take on the second dictates what your interest rate is on the first. But regardless of how much you take for the second, 2, 3, 4, 5%, 1/3 of that second disappears every year. So at the end of 36 months, you don't owe on that second. You still have the first, refinance at any time, which is another thing to look into. So you really shouldn't consider refinancing these for at least six payments or 8 months. They would love for you to keep them forever, and I understand, and that's their incentive. GSFA's Platinum, their incentive to reduce the balance on that second and forgive it after 36 months is to incentivize you to keep paying on that higher interest rate first. And it may in fact be worth it. We can crunch the numbers and see what's best for you. But that is a wildly popular program. I usually look at that one second, CalHFA first, Platinum second, and then Open Door third. There's a ton of them out there. These are state programs that are available statewide, depending on, it doesn't matter what city, county, as opposed to there's lots of city and county ones that may be better. Generally speaking, their income limits are a bit lower, but again, we take a look at the scenario and we find out what's best. We talk about it, develop a goal, and accomplish it. That's the name of the game.